Yalimath, everyone. My name is Alim Somani, and I am our Alliances Canada leader. And I'm happy everyone is here and was able to participate in this webinar on our innovation economy. In Canada, we currently have 31 alliances covering a whole wide range of professions and business areas. Alliances in Canada bring together Ismaili entrepreneurs and professionals to help them better themselves, to teach and learn from one another. And when these actions happen, the alliances become a tremendous source of strength and support for the Jamaat. If any one of you are interested in learning more about our alliances, please come to alliancescanada.org and join an alliance. I hope you enjoyed the webinar. Take care. Yali Madat.
Well, good evening, everyone, and thank you for joining us for this special webinar on the state of venture capital and entrepreneurship in Silicon Valley. My name is Irfan Raji, and I'm delighted to be joined this evening with three renowned venture capitalists, all of whom are in Silicon Valley: Farooq Ladha, Todd Simpson, and Arif Jan Mohammed. Gentlemen, thank you for joining us this evening. To give you a bit of background on who's here, Arif Jan Mohammed's a partner at Lightspeed Venture. They are a large venture capital firm, well known, and have offices around the world. Arif's also been a founding member and founding board member of the C100, which many of you have probably heard of. He has an MBA from the Wharton School at the University of Pennsylvania and a Bachelor of Science in Computer Engineering from the University of Waterloo. Todd Simpson is a longtime entrepreneur, over 20 years as an entrepreneur, and is now a partner at Inovia Capital. Inovia has offices in Canada and the United States. Todd is originally from Canada. He actually has a BSc and a PhD in computer science from the University of Calgary. He's an author and holds multiple patents. And finally, Farooq Ladha. Farooq is the founder of Four Rivers Group. He founded Four Rivers Group in 2007. Prior to that, he was at Silicon Valley Bank Capital, which is affiliated with Silicon Valley Bank, probably the best known venture debt provider. Farooq has a BA in economics with a minor in Islamic studies, graduating summa cum laude, Phi Beta Kappa, and with high honors from Dartmouth College, and an MBA from Harvard Business School. So we have quite an esteemed panel here today. Thank you, gentlemen, for joining.
Thank you, Irfan.
Thanks. Thank you.
I think maybe to get started, it would be most helpful to our audience to understand a little bit about each of your firms. And so maybe, Farooq, I could start with you. Could you tell us a little bit about Four Rivers Group?
Sure. So Four Rivers Group began as a growth equity venture capital firm focused on technology companies in large markets that had shown early signs of an inflection. And we came in after the Series A venture capitalists took most of the product market risk off the table, and the companies were at a point where adding capital would help them achieve hyperscaling growth. Since then, we've become a multi-product firm. We've added a seed investing practice focused on very, very early ideas, as well as a secondary investing practice, buying shares of established technology companies directly from entrepreneurs. And the idea behind Four Rivers is to continue growing into a multi-product, multi-facet firm, but always focus on technology, more often than not software and enterprise-facing software, with some consumer-facing investments.
Great, thank you. Todd, maybe a bit about Inovia.
Yeah, so Inovia Capital is a Canadian venture capital firm founded in Montreal about 13 years ago, back when there was almost no venture capital in Canada. So one of the early firms building out venture capital in Canada. And based on that early start in Canada, Inovia really focuses on Canadian entrepreneurs. So most of our investments involve a Canadian either referring the deal to us or leading the company or building the company or part of the company in Canada. And so that's sort of how we compete amongst all the venture capital space. We are a full stack firm as well. We have both a venture fund, which does early seed and Series A investments, and we have a growth fund, which does Series B through pre-IPO. Both funds are very active, and we're in the early investment stages of our two latest funds. So luckily have some money in the bank during this COVID period.
That's great. And Arf, maybe obviously last to you a little bit about Lightspeed.
Yeah, sure. We're a global firm, multi-stage. We're headquarters in Menlo Park, which is in the heart of Silicon Valley. We have an office in San Francisco. We also have presence in Israel, India, China, London, as well as recently opened an office in Southeast Asia. For us, with the heart and soul of Lightspeed is early stage investing. That's where we began about 2 decades ago, but over time we've actually expanded into growth stage investing, and we've also got a global opportunity fund which can invest at the latest stages pre-IPO of companies. We were very lucky to raise $4 billion in capital just before COVID hit. So in March we closed 3 funds. An $875 million early stage fund, which focuses on seed, Series A, Series B, a $1.8 billion growth fund, which focuses on Series C through probably E and F, and then a global opportunity fund, which can invest anywhere in the world, check sizes anywhere between $50 and $100 million. And that'll, in many cases, invest in our existing portfolio, but also new investments.
Great. Helpful to understand your context, and obviously a ton of experience on this call with different style investments, obviously different stages across each of these different firms, but all of you working and living in Silicon Valley. And I'm sure we're all wondering, irrespective of if we live in the Valley or elsewhere around the world, what's it been like there over the last 6 months? So a huge amount of change given the pandemic. And maybe each of you could give us a bit of your thoughts around really 3 specific subtopics within that. Number one, what's it like for your portfolio companies? Like what's it like for these businesses? How have they managed through this? The second is, what's it been like from a financing perspective? And so like, what do the financial markets look like from a venture perspective? What are the trends that you're seeing? We're seeing a lot of news with respect to very large rounds in certain sectors, and some rounds seem silent. And I'd be curious to know from an insider perspective, what's really happening on the ground. And the third is, you're seeing in, journal articles in like the Wall Street Journal or the New York Times, a lot of chatter around the hollowing out of Silicon Valley now that remote work is possible. And what are you seeing with respect to that? Is it possible to now have Silicon Valley funded companies but not be in the Valley, or are there other trends that you think may exist, or is this just a temporary thing? And maybe we'll go in reverse order this time. Or if you want to kick it off, and you guys feel free to jump on in and question each other or disagree.
Yeah, lots to digest there, and I'd say it's not one question; it's 3 big questions, and there's a lot of meat there. And so I think, why don't I start it off? But I think we should just create a discussion here, because it'll probably be ping pong between us. Portfolio companies, March, April, May were very intense for most venture capitalists around the world, not just here in Silicon Valley, as we really digested the new normal, COVID, post-COVID. What does this mean? Will the economy fall apart? What will the Fed do? How will financing really be affected? And for many of us, we had lived through the 2008 great financial crisis. Some of us, actually 3 of us around the table, had lived through the dot-com bust. So the big question was, is this going to be really, really bad for the startup environment? What does this mean for the financing environment? And what does this mean for the macroeconomic worldview over the next 6 months, 12 months, and then 24 months? And so March, April, May for us at Lightspeed was spent very much looking inward into our portfolio, spending a lot of time looking at burn, which is the amount of cash that a company really loses a month as they spend to grow, and cutting burn, and ensuring that our companies had, in the case of a downturn or a recession, had at least 2 years of runway. And that meant making some very, very tough choices, not only in terms of reducing future hires across engineering, sales, marketing, customer success, other areas, but also looking inwards at existing headcount and really trimming down existing headcount. And so internally across our portfolio, we looked at companies that had less than 6 months of cash, and really tried to figure out how to triage those companies in terms of adding additional capital into them or finding quick financing routes. There were companies that had 6 to 12 months of runway, and that was very much an exercise in reducing burn and extending runway. And then there were those companies that had 12 to 24 months, where it was just about recasting financial plans and being a little thoughtful about growth and future hires. that's how we spent the first 3 months. And then the next 3 months, it was getting used to a post-Zoom world. It's exactly what we're doing right now. It's not meeting in coffee shops, not having serendipitous conversations in the street downtown San Francisco. There've been multiple times where I bumped into Farouk on the corner of Market and Third, right? I miss doing that.
No.
Right. And, it's very much been schedules, right on the dot for Zoom meetings, getting comfortable with getting to know new entrepreneurs, getting comfortable with making investment decisions around new companies, new entrepreneurs. And also, on a personal note, dealing with our personal situations where we're, as you can tell, I'm sitting in my living room. Actually, this is my bedroom, but, sitting in my bedroom where my kids are, on Zoom and doing, remote work at the same time. So it's not only been a professional shift, but also a personal shift. So that's the first question. I'll pause there so everybody else can actually weigh in on this before we go tackle the other two around, the other two questions that you had.
Yeah, I would reiterate everything Eric said about the first 3 months, where it was very inward looking. We had the same strategy: manage burn, try to get 24 months of runway for everybody. But I think at some point in that period as well, we started to separate the portfolio into those that were going to take advantage of COVID. That sort of digital acceleration was going to create a tailwind for certain types of companies. And then companies where it was obviously going to create headwinds. And then the ones in the middle where it was really uncertain, we sort of called them the quantum companies. They were both accelerating and decelerating at the same time, and you weren't quite sure where they were going to end up. So we spent a lot of time making sure everybody had enough cash and the burn rates were under. And then we started to get these three groups and start looking at actually accelerating the ones where COVID should be a tailwind. I think that was after maybe the first 2 months, once the main panic had receded, the stock market started to bounce back up a little bit. And that sort of leads us into the current environment, where I think there are some amazing companies that are taking advantage of the current situation and are going to be dramatically accelerated from where they would have been 6 months ago in the status quo. And then there's those that really are sort of waiting or on the sidelines until certain markets come back and certain behaviors are restored or not. And I think at this point, there's less on our sort of uncertain list. They've all sort of fallen into the two buckets now. We can sort of tell which direction they're going. But that's also a tough chore to try to look dispassionately at the companies and see what the new world is going to mean for them.
Yeah, I think to both of your points, that's what surprised me the most, which was, March and April were pretty bleak months. It felt like we were going to be in another 18-month cycle, the way 2008, 2009, and the way 2001, 2002 felt. What surprised me was how quickly June and July brightened up. And we saw remarkable resurgence among the portfolio to the point where just about every company hit Q2, and not the revised Q2, but the original Q2 plans, after having some horrid Q1s. And what we realized was, initially we cut pretty deep. Then we thought maybe we cut too much. But then what we then realized was, we cut that deep and hit Q2. There was a lot of fat that we didn't realize we had, because during good times we got sloppy.
Yep.
We got sloppy because capital was cheap, capital was plentiful, and bad habits were formed. And one of the reasons why the best companies are formed in bad times is because resource constraint forces good habits. I began my career in 2001, 2002 in bad times, and that was great discipline. And so that was the first kind of surprise that came about of this summer. And I think the second surprise was the return of the capital markets so quickly. Obviously, stock markets are all-time highs, but the tech markets are higher than they were before COVID, and private capital is plentiful and fairly valuation insensitive at this point. So it's a very weird time, because sometimes I forget we're in a pandemic. I forget we're ostensibly in a recession with almost 10% unemployment in the United States, because the economy and as a result of technology is just bifurcating more so than it ever has. And that's been the second big surprise. I would echo one last comment Arif made, which is that the personal the personal adjustment has been very interesting. Working from home, having my kids who are 3 and 5 running around, participating in board meetings involuntarily. And by the way, they always vote very, very ungenerously during comp committee meetings. But it's just been kind of funny to have them, in my life far more than I ever expected them to be during the middle of the workday.
Yeah, the financing environment has been, that was the second part of your question, Irfan, the financing environment. And so we had a few companies that had to go out and raise in March, April, and that was a really hard time to raise. And the reason was because all three of us and the rest of the venture capital community were looking inwards and really doing portfolio triage, and we were spending time trying to figure out how do we really triage the portfolio, and we were spending all of our time with our portfolio. And then as the stock market rebounded in June, July, it was risk on once again. And it's really been a tale of a couple of financings. If you were raising, God forbid, March, April, May, God, terms were pretty onerous, but you took the capital because, as most people know, if, the most important thing for a startup is to survive. And so you took the capital. And then over the last 2 to 3 months, I'd say venture capital activity, especially at the late stages, and this might just be a flight to safety, it might be a flight to, better risk reward. There's been an incredible amount of very fast, very high priced, and very high capitalized rounds coming together, really, in the best companies across the valley and actually around the world. And at the earliest stages, seed, Series A, I'd say that there's been a lot of attention given to exceptional teams that are tackling very, very big problems. So, teams that have come together that have a very strong pedigree, that have, a very big idea, those teams have been able to get pretty good seed or Series A financings. Also, companies that have shown traction post-COVID, right? Anybody in e-commerce, whether it's, where we've seen, 10 years of e-commerce crammed into 3 months, those companies are seeing incredible growth. Even at early stages, they've seen very strong financings, anything to do with remote work. A lot of AI companies, which are, making companies more efficient in a post-COVID world, they're seeing financings. And then the financings, candidly, that have been harder are for, potentially unproven entrepreneurs that still need to go find product market fit, teams that haven't quite cracked the code on go-to-market. Those are potentially harder financings, where, they are getting done, but they might not be getting done at the valuations that those entrepreneurs are looking for, or they might not be raising the amount of capital that those companies originally wanted to go out and get. Is that what you guys are seeing? Todd,
for
and,
sure.
in Canada,
Yeah, for sure. I think, said another way, the sexy companies are inundated with term sheets and offers and can almost write their own terms right now. It's, crazier than it was pre-COVID for some reason. I think maybe everybody's feeling the euphoria of the capital markets coming back, and there's lots of capital on the sidelines and whatnot. So it's a fairly active market right now if you're in that sexy group. So software, fully digital, enabling everybody to become more digital and participating in that acceleration of e-commerce and everything becoming digital, work from home. If you're not in that group, then things are really tough. And my experience in the last 3 months, that would include anything that has to do with hardware that's long time to market, still deep biotech, or things that aren't sort of pure software that have the leverage that a pure software company has. But the pure software companies are just leaping ahead. Like I haven't seen. I've only been in venture capital 3 years. Before that, obviously, I was running startups. But in my 3 years as venture capitalist, this is the craziest I've seen in the market.
Can we dive into this topic a little bit more? Because I'm sure that folks that are watching this webinar are curious. You're all technology experts. We're seeing the public markets trading at pricing that, Farouk, you already alluded to this, which is greater than it was pre-COVID. Numbers that, maybe some people would say don't make sense. It sounds like from the three of you that actually has traveled back into the private markets as well, where the winners are really surviving with great interest and accelerated pricing in good terms. What do you think? I mean, we're all investors also in the public markets with our, pension plans and otherwise. And there's a real debate that's happening now that some people are saying this is overvalued, some undervalued. What do you think from your seat in Silicon Valley about these valuations of the public markets? And is that what's driving what you're seeing in the private markets? Are specifically to what you had said, later stage financing for the winners. I mean, they're going at big numbers, which maybe is because they're so close to the IPO window that people are, it's a shadow of the public markets.
Well, you have to remember there's one key difference between the financial environment now and the financial environment pre-COVID, and that is that we're in a zero interest rate universe. Mm-hmm. And basic finance theory tells you that as the discount rate approaches zero, valuation approaches infinity. So to put it crudely, where else are you going to go? And that's kind of how people are thinking right now, which is as they're evaluating all their asset class options, there's really a much smaller potential universe of yield than there is in growth. And so technology or high growth is getting bid up to reflect that. So it's not, from that perspective, it's not horribly irrational. That doesn't mean it won't end poorly. It just means it's not horribly irrational. I think that's number one. And I think number two is technology is permeating a greater and greater percentage of GDP and the economy nationwide and globally than it ever has before. And it's also entering industries that it never has before. When I got into the business 20 years ago, a lot of industries from construction to all sorts of to companies like MindBody, so yoga studio, they would never have employed technology. It would have been a failing proposition to try to disrupt those industries. Now, those are part of a very normal universe of technological customers. So a $1 billion company in software in 2003 would have been truly a rare, one-of-a-kind, mind-numbing outcome. Now that's a Series B. It's a very common thing because I can name at least 10 companies, if not 15, that have reached $10 billion valuations or more. That was not even in the most creative universe of your imagination would you have come up with that 10 years ago. So I think public markets are seeing that. They're saying, look, these things can get really, really big. Our cost of capital is lower than a typical private investor. They can afford to bid up these companies. And then, of course, that trickles down to the private markets because private markets look to the public universe as comparables. So that's kind of what's going on.
Yeah, I totally agree with that. Go ahead, Todd, and then I'll...
I was just going to say that's also, I think, growing realization in the market that some of these software and advertising-based companies actually have very low risk, right? I mean, buying into a SaaS company is almost like buying a bond. It's, unless something goes dramatically wrong, you can actually predict into the future pretty well. And so the predictive potential in the software market has also increased as more and more SaaS has hit the markets. And so that gets very highly valued by the markets as well. So there's a lot of things coming together. And to your point, I think it's still low teens of US GDP is actually, quote, technology companies, although it is sort of pervading everything else. So there's lots and lots of room for growth for the software companies going forward. It's not like software is eating the world. No, we've barely taken a nibble. There's still lots of eating to go on.
Yeah, I in addition to what Farrukh and Todd said, I would say that there's a growing realization among not only private but also public investors that the market sizes for modern SaaS is actually much larger than it used to be when Farrukh and I both entered the business as investors. Historically, the business model was very different. You'd start every year with zero revenue, zero bookings. You'd send a bunch of salespeople out, and then those salespeople would sell perpetual licenses. And then you wouldn't be able to go touch those customers for another 3 to 5 years, until those licenses expired. in the case of a recurring business like a Salesforce.com or a ServiceNow, you start at $10 billion of revenue if you're, depending on the size of your company, or a billion, or 100 million, or 5 million. And then if your salespeople go out and add another 10 billion of revenue, you've just doubled your annual recurring revenue. And so it very much is a change in business model, but also market size, right? When 20 years ago, 10 years ago, the buyers of technology were primarily IT, information technology folks. It was the CIO, the Chief Information Officer, that was the main buyer. And that buyer would basically spend $1 million, $2 million, $3 million on enterprise software from companies like an Oracle or an SAP or a BMC or an IBM. And then startups would fight for the scraps. In this new world, the CIO still has quite a lot of buying influence. But actually, what has happened is that software spend has actually permeated across the organization. So it's not just the IT buyer, but also the marketer, the salesperson, the engineer, the developer, the customer success person, the HR person, right? The procurement person. Each of those now has budget. And if they don't have budget, they just stick it on their credit card and they ask for forgiveness later in the form of an expense report. And so software is completely permeating the entire enterprise. And the result is that the total spend on software is actually taking over what used to be spent on human capital in many cases. So, there's been a shift from people-based spend where you'd spend on, Accenture, Deloitte, or consultants, or even people, humans in India or around the world. And that is now being replaced by a lot of software. And then you look at the rewards that are being given in the public markets because of this change in business model, because of these larger markets, right? This last week, actually, we saw 5 IPOs. And it was a historic week, right? Because we're at market highs of all time. But ServiceNow's former CEO, a guy named Frank Slootman, took over as CEO of a company called Snowflake, which is a database company. And Snowflake tackled one of the hairiest, biggest, ugliest problems of the last 40 years, which is taking on the database, which is Oracle, IBM, and then more recently it was companies like Amazon and Google. And the company ostensibly only has 264 million in revenue, but is growing at an astronomical rate. And the company is now valued, I haven't checked it today, but it's valued at somewhere between 60 and 80 billion, depending on what day you look at it, right? So it is an outsized reward for a company that is growing at an incredibly fast pace. And the same thing happened, to companies like Sumo Logic, which just went out, Unity, which also went out, JFrog, which is selling to developers, not even the CIO, but to developers, right? And there are others. There's a lot of other companies that are selling directly to developers, like an Atlassian, that are getting outsized market sizes.
You guys have done a very
let me add one more comment, which is that when we got into business, a profitable software company was generating 20% net income margins, and that was a really good business. Now, these SaaS companies generate 40, 50, and I just saw the first 60% free cash flow margin. So it's not irrational for the valuation of a business to have tremendous multiple expansion when the profitability metrics tripled. Holding growth constant, and here growth rates are actually growth rates now are faster than they've ever been before. The amount of time it takes the winning company to get from 0 to 100 million is faster than it's ever been before in revenue. So you couple that with profitability rates that are higher than they've ever been before, it stands to reason that the multiple of these businesses, the valuation multiple of these businesses, should be far higher today than they were 20 years ago or 15 years ago.
Yeah, tying all that together, the SaaS model is also evolving. As Eric said, the SaaS of Salesforce is not the SaaS of Slack, right? Slack is bottoms up SaaS. They don't even need all the Salesforce and all the time or whatnot. And so their capital efficiency goes way up, their margins go way up. And so there's this stratification even within SaaS companies of those that, based on who they sell to and how they're adopted into the enterprise, that can make some of the bottoms up ones even more attractive than ones that need large enterprise sales staff. Still selling to traditional buyers. So there's lots of interesting things going on in the market.
Yeah, but the financing environment is also it's the haves and have-nots, and so those companies that are on the wrong side of history, that are selling on-premise software or selling hardware, only hardware, that are selling perpetual licenses. Those companies are they're having a hard time raising capital. So
Yeah.
it very much is, if you have a recurring model, if you have a highly efficient go-to-market model, if you've got a good CAC to LTV ratio, customer acquisition cost to long-term value, you're getting great multiples. If, on the other hand, it's a grind and you're selling to the CIO and you're trying to go out and take down whales, you're trying to get $2 million, $3 million, $4 million deals at a time without the run rate business, which sort of fills in the quarter, which then means that you've got lumpy quarters. Well, then, you're having a harder time raising.
You guys have done a very good job of explaining things that, contextually we see in the press that, maybe the press doesn't really understand, and really taking it to its basic building blocks to explain why this is logical and makes sense. For your point that, like, when you have interest rates that are zero, valuations are technically infinite, and if you said something that 10 years ago, I think we would all chuckle at. You're like, you go out and you get another $10 billion in sales this year, and then you double. But that actually happens, right? Like, that is not a thing that doesn't happen. And it's not just happening for one company or two companies or three companies. This is a very different macro context, a very different business model. We're in a very different time. And on different times, one of the other things we read about is that, Google has said, don't come to work until next year. Just work from home, work from Minneapolis if you want. That's fine. Facebook is like, never come back, live wherever you want. So we read about that. What's really actually happening on the ground, guys? Like, so you all live and work in the Bay Area. What are you seeing?
Yeah,
Mark, why don't you start, because you're in the city, so
Yeah.
you're describing it to me.
Well, look, I think right now everyone's working from home because there's no other option. And yeah, the city looks like, anyway, it's a mess. But I'm actually not one of these people that believes that 3, 4, 5 years from now we're going to be in this permanent work from home type situation. I'd say a couple of things. First, if this is truly a 1 in 100 year type of pandemic, and there's no relapse, this will feel like a quaint memory 5 years from now. Much like the people who after 9/11 said travel's never coming back, people will be perpetually frightened, and then 5 years later we were at all-time travel highs. So I think Reed Hastings, put it well, the founder and CEO of Netflix, who said, when asked, what has work from home brought Netflix in terms of efficiency, he said nothing. And then when asked, when will people come back to work, he said, the day after a vaccine's approved. Now, that's an extreme point of view. I think the answer is somewhere in between. There might be more openness to a balanced work approach. Maybe it's 4 days in, 1 day out, the way the consulting firms do it. Or there might be more openness to having a flexible work schedule during the middle of the week. But I do think that the serendipitous contacts of an in-person office, the ability to disagree in a face-to-face meeting, the ability to come together and build culture is really best done in person, and that's what we'll come back to. I also think that for a lot of people, going to work is a primary form of social outlet. It's human to want to touch and feel each other. It's human to want to interact with each other in a face-to-face manner. And I think that you can't zoom that away. We are wired the way we're wired. So I think the best case scenario from work from home is some sort of flexible arrangement, but certainly not a permanent arrangement. Facebook and Google may change their minds next July. We'll see.
Yeah, I agree with all of that. I think we will end up somewhere in the middle with some more flex time or whatnot. But I think in the meantime, we're going to see huge innovation in making work remote better than it currently is.
Yep.
I think, Zoom, like we're on today, is a great piece of technology, but it was built very much for a conference call by video. It wasn't necessarily built for working if you're a mechanic helping somebody fix something versus a psychiatrist trying to help somebody. Those are really different environments. And, tools like this will probably end up segmented and having very specific layouts and features and whatnot that improve that remote work experience for when you are doing it. And so I think this experiment forced on us by COVID-19 is actually going to drive a lot of innovation in these places, including, what KPIs do you actually use to measure performance? Is clocking in 8 to 5 still the right thing for more legacy industries to be measuring, or are there better things to measure? How do you do customer engagement? How do you do all these things better? So I think we'll come out of this with a lot better tools than we came into it with.
Yeah, agreed with both of them. I think I wholeheartedly agree. I don't believe we're all going to be working from home or sitting at home, in perpetuity. And if we are, then God help us, because we are social beings, right? My kids want to get back to school, and there's something special about recess. There's something special about seeing your friends, and there's something special about seeing your coworkers. And there's something very special about whiteboarding an idea, and the energy that you get from body language that gets those little cues that we miss because we're in 2 dimensions right here. What I will say will change forever is there is now a growing acceptance that Silicon Valley companies don't have to be 100% Silicon Valley, and I think that's actually an amazing thing to come out of COVID, because prior to COVID you'd have this I don't know the right word, but I can think of it in French, but it's this preconception that you had to aggregate the best engineers, the best salespeople, the best talent in an office, down in Santa Clara or up in San Francisco. And, there were a few rogue companies like GitLab or HashiCorp or others that had gone fully remote, and, people would sort of look at them and say,
like Elastic Corporation.
Or Elastic, of course. Yeah, Elastic. That's another one. And now, post-COVID, people have realized that you don't have to have your engineers in the same office, that, it is possible to get amazing efficiency and amazing productivity with engineers, with salespeople, with marketers, with customer success folks scattered across the globe. And there's also a huge acceptance of the fact that there's amazing talent around the world, right? That there's Silicon Valley will still remain Silicon Valley because there's just an experience gap that is hard to catch up with. And so there still is some amazing talent, and there will be for a good period of time, people here who have just seen the movie before and have experience that other people around the world don't. But on the other hand, there are amazing engineers who, companies here that are headquartered here, or companies that are started around the world, can actually go hire, can onboard, and using the new tools that are getting invented as we speak, that Todd was alluding to, can actually collaborate together and work together. So I think the future is hybrid, where it's not just one major headquarters, it's a number of headquarters. It's maybe it's 4 days on, 1 day off, maybe it's 3 days, 2 days. I don't know what that is, but it's certainly going to look different in the future. And the tool set that we use are those are going to get better. They're absolutely going to get better. They're going to improve. And right now we're at peak Zoom, but 5 years from now Zoom will look quaint. Well, the Zoom that we're looking at will look quaint. I wouldn't bet against Eric because he's an incredible entrepreneur.
Yeah.
But the other thing is, Zoom's got a valuation north of 100 billion, so that's going to invite segmentation. So that's going to accelerate itself, because the 10 years ago, if you backed a video conferencing company, you got $1 billion outcome. That was or maybe 2, that was considered top of the market. Now, what the 100 billion has shown us is how much interest there is in the space. And so, there'll be a very large financial reward for segmenting it up. So it will happen.
Yeah.
As we're thinking about that, like the trends of the world and future of work going forward, you guys have done a really good job of peeling back, the curtain and showing us how you thought about your portfolio and what financing looks like over the last 6 months. If I'm an entrepreneur, and I've got to start up a scale up, help me think about the next 6 months. What should I be doing with my business? So each of you were talking about what you coached your portfolio company CEOs to do in March and April, and then in July, and what's been like now in September. Help me think about, if I'm running my company from an operating perspective, but then also a financial market perspective, like what does the next 6 months look like? What are you telling your portfolio company CEOs now?
Today? Oh, go ahead, Todd.
Yeah, okay. I would say we're telling them to be cautiously optimistic if they are in a good place today, right? I think we're all or at least I am still a little skeptical of how well this recovery has gone, and the fact that capital markets are at all-time highs, and that a vaccine is going to arrive right before the US election, and that everybody's going to accept it as a miracle, right? So I think there's still potentially some rough waters ahead, but we've come through this, at least for these software companies, better than any of us could have foreseen 4 months ago. So we're sort of coaching for cautious optimism. And then to Farouk's earlier point, but there's no need to increase your burn rate, given there was probably a lot of fat previously, and you've slimmed down and you've still hit your numbers. And so cautious optimism with also cautious investment, unless obviously you're growing 20% month over month, in which case you're going to increase your burn to fuel that growth. But a little more cautious than pre-COVID, but certainly not as pessimistic as March, April.
Yeah, cautious optimism. If you can get capital right now, or you can access capital right now, go find it, because the mood is good right now, and as we saw back in March, moods can change very quickly. God forbid there's a terrible second wave in the fall, or early winter, and maybe there are some challenges around vaccines. Well, the mood can change very, very quickly. We're also getting close to a difficult election here in the US. Who knows what the outcome will be. So right now is a good time to fundraise. Right now is a good time to put capital on your balance sheet. Thinking 6 to 12 months ahead, nothing solves problems for a startup than revenue and customers. So go find product market fit, spend your time with customers. Second, actually equal to customers is talent. Bring great talent into your company, people who are as good or better than you as a founder, who are just going to help you and your co-founders scale, right? So focus on talent, focus on customers, find product market fit, and then network your way into venture capitalists to build those bridges, and to really, sometimes financings can take a while, but to build that trust with a set of venture capitalists, so that when you do hit that magical set of milestones that particular VC is looking for, you're ready, you've built trust, and you've built a relationship.
The only thing I would add is we've used the good times in the summer to make sure that all companies are at 24 months of cash.
Yeah.
So we are definitely playing the cautious route. We're not slowing growth. So in March and April, we actually actively decided to slow down growth because we weren't sure how long this was going to take. We're not doing that anymore. We're maintaining growth rates at the natural levels of that industry or that company's capacity to grow. But we capitalize the businesses in addition to that, so that we have 24 months as of now. Should anything relapse or get worse or anything like that.
That's super helpful advice. One thing I know that people are going to want to know in the Jamaat as they're watching this, really around the world, especially younger members of the Jamaat, you've all done incredibly well in your careers. You're all very well respected, well known, working for great VCs in Silicon Valley, which is, really the heart of venture capital in the world. So you've come quite a long way. What's the one thing that you wish you knew when you started your career that you figured out along the way that you know now, that if you had that nugget, it would have been easier, it would have been faster, the hardest learning maybe? Is there one piece that you would offer the younger members of the Jamaat?
There's this age-old piece of advice. It probably goes back hundreds of years, but it's not what you know, it's who you know. And so the power of network, never underestimate the power of network. And so invest in relationships. And that word invest is super important. Don't be transactional about the relationships that you have, but really be, think about a relationship and a set of relationships as an investment. And, the people that you're working with today are the leaders of tomorrow. Great people that you're working with today are the leaders of tomorrow, but also seek out mentors. Seek out great mentors who can help you along the way.
I wouldn't be where I am today if it weren't for a mentor. I was unqualified to enter the career I entered. I may still be, but at the time I certainly was. And my mentor decided to take a bet on helping me, and that it changed my life. So absolutely seek mentorship and invest in that, and being a good mentee, and build on that. I think, echoing Arth's point, at least what we do for a living is based so strongly on relationships that absent them, I don't think it can be done. And so for me, investing in relationships, particularly in the Valley here, is about giving more than you're getting. So, and you give unconditionally into the relationship. So when an entrepreneur who I'm not going to fund pitches me, and I say, I'm not going to be able to fund you for X, Y, Z reasons, that doesn't end the relationship. Then it's, let me think of 3 other people for whom this might be a better fit, or let me think of some advice I can give you that may change the way you pitch the opportunity, that may make it a better fit for the next one. Or if I make an introduction to a company, to a set of customers, and I'm not an investor in that company, but it's just kind of good karma to do that. 3 to 4 years from now, that entrepreneur will remember that and tell their friends, boy, that photo guy, I mean, he didn't invest in me, but he made an introduction to a customer and I got a customer out of it. I expected nothing in return, but that's a relationship. That's a piece of goodwill that you've put out into the community, that if you do that at scale, you have a lot of people who are rooting for you, who want you to win, who want you to succeed. And that's really been the source of everything for me. It's been this kind of strange pull from the community of Silicon Valley that has wanted me to succeed and helped me to do so, even though they have no financial benefit in my success. So, and I really strongly believe in making sure that you're always giving, always giving, always giving to the community, and really without expectation of return. And then the final comment I'd make, particularly to someone who's 21, 22, 23, coming out of school, don't get lost in the importance of prestige or salary in your first couple of jobs. It's irrelevant. What you make coming out of your first job is, I was, I think, bottom 10% of what I was getting paid. Bottom 10% of my Harvard Business School class. I'm sure of it. I wasn't making anything coming out of HBS.
One would argue the bottom 10% of Harvard Business School is the top 10% of the rest of the world. So, I mean, let's not complain too much.
The point here was not to complain, was to say that it was an irrelevant determinant in the choice I made. And what my mentor basically said was, just sign the paper with whatever the salary is on it. It's irrelevant. But what you're going to get by joining, and I joined SVB, which was a very atypical place to join coming out of business school, is, he says, you're going to get relationships, you're going to get experience, you're going to get access to an industry that's impenetrable otherwise. And 5 years later, you'll probably either start your own firm, or you'll join a very well-regarded firm like ours firm or something, and you'll have both options. And as it turns out, both came true. So don't overvalue yourself at the beginning in terms of your financial needs and abilities and contributions, and don't worry too much about if it's a brand name firm. Get the experience you're looking to get. If you have to work for less, work for less. Get in, get the experience, and make as many friends in your industry as possible, and become very, very well networked.
Yeah, I think that's excellent advice. Network, and then reputation, which takes a long time to build and is very easy to lose, is almost everything in this industry. So building those is great. Maybe I'll talk from the other side. I spent most of my life as an entrepreneur. And so maybe my lesson was more starting my first companies and raising venture capital. And I think my advice would be that incremental innovation is okay. I tend to be the person that wants to do radical innovation, right? You want to change the world. You want to improve something dramatically. You want to change things completely. And it's actually a lot harder to succeed at your radical innovation if that's where you start. And so starting with sort of incremental innovation, but having a roadmap to where you ultimately want to get to, I think is good advice for young entrepreneurs starting their first companies. And as VCs, we want to hear sort of both those sides of the story. We want to see that there's a large disruptive market opportunity, but we also want to see that there are some small tangible steps that can be taken in the next 6 months, in the next year, that open up that wider opportunity over time. And those tend to be the entrepreneurs and the ideas and the pitches that resonate most and have the most chance of success. So dream big, but add in a staircase to get to the clouds.
This is super helpful advice. I'm going to end with one last question that is my favorite question to ask, irrespective of the topic of a webinar, when I'm with really, really smart people. And you're obviously very smart, but you're also very good investors. The returns of each of your funds speak for themselves. Unfortunately, for almost all of us, we don't have the opportunity to be investors in your funds because it's just the structures of these funds. But you all probably also have public market investments. And so the last tip, I'm very curious to hear, in your personal portfolio, public market investment, what's the one stock that you're really excited about? And what's your thesis on that? What's your tip? So the smartest investors in technology, where are you putting your personal money in the public markets? Arf, I'm going to start with you, and then Todd will end with Farouk.
Long time long Amazon. I mean, right now in COVID, we're basically running a shipping department for Amazon. So, there's boxes that arrive every single day. I've lost track of what it is. We get our groceries now through Amazon, Whole Foods. Most of our companies are procuring their cloud computing requirements from Amazon. It's just an incredibly well-run business. It's an incredibly well-run organization, and it's maniacally focused on dominating every single industry that it gets into.
Todd.
Yeah, I'm actually maybe going to go slightly counter in that. I don't do a lot of individual stock picking. I'm basically an index investor because I take my risk in the venture capital side and whatnot, so I'm fairly safe in the public markets. And of course, it's a myth that public companies, the public markets, grow 7% year over year on average over time. What actually grows at that rate is the S&P index or the QQQ, which are carefully picked stocks by those exchanges that represent the best of the public markets over time. And so if you want to do safe investments in the public markets, I think the indexes are still well worth looking at.
And Farouk.
I just have a basket of SaaS companies. So it's kind of a hybrid between RF and Todd insofar as it's a basket. It's not an individual name, but it's a heavy commitment to the business model of recurring revenue software, and it has obviously outperformed the market for a long time, and it will continue to do so because it's probably the highest growth segment in one of the largest TAMs, total addressable markets, out there.
This is great, guys. Thank you so much for your time and your wisdom. I know that folks certainly will appreciate it. And good luck to each of you and your companies over the coming months. Have a great night.